Alessio. Hope you're well, and welcome to another update on the financial markets. In this video, we're going to take a look at the chart of the market that knows all, the market that knows everything. Now, if you've been watching my videos for a very long time, you know which market I'm talking about, because the market that knows everything is not the stock market, it's not gold, it's not Bitcoin, it's not the currencies. It's actually this. Here's the chart. This is the bond market. Now, this is the chart of TLT, 20-year treasuries, but you can also look at the other bond markets too, like the 30-year treasuries, 10-year if you want. But I quite like the chart of 20-year treasuries or TLT. So why does the bond market know everything, and why is it so important, and what is it telling us right now? So the reason why we say the bond market knows all or knows everything, because bonds are not traded by your average person, by your average Joe. Your average Joe trader out there is not trading bonds. They're trading, the average person is trading stock markets, gold, Bitcoin, currencies, or things like that. The majority of the time, bonds, however, are traded by institutions. So bonds are typically traded by big institutions, big funds. So for that reason, what the smart money, what these big institutions are doing, how they're betting on the bond market is quite important. So often we see signs or warnings in the bond market before we see it in the actual stock markets. It is one particular market I do watch. And notice what's happening so far, or what's been happening so far in the bond market, in bonds or TLT. Notice that bonds have been going up with the stock market. In fact, both stock markets and bonds have been going up so far in the past few weeks and months. Now, you may be asking yourself, well, so what? The fact is actually usually bonds and stock markets often go in opposite directions. In fact, bonds are often seen as a hedge against stock markets. So usually these markets often move in opposite directions, but in fact, in the past few months or recently, in fact, bonds have been going up with the stock market, in fact, going up together. That's not a good sign, because that means one of these charts is not correct. Something is not quite right here. So essentially bonds are telling us two things. The fact that bonds have been going up, they're telling us two pieces of information that we need to be aware of. Firstly, whenever bonds are going up, it means the forces of deflation, not inflation, are still with us. So at the present moment, given that bonds are still in a strong uptrend, a very strong upward trend, bonds are telling us that the forces of deflation are likely to be with us at least for some time. So deflation is winning and inflation is losing. So that's pretty bad. And actually, it's not surprising when you think about it, because most recessions are deflationary. We are right now in a deflationary market environment. By the way, speaking of recessions and deflations, it's interesting because the most recent report came out. You probably heard the most recent report in the last few days about GDP. GDP figures came out showing we've had negative growth for the last quarter. Now, of course, it's terrible news that we had minus 33% GDP last quarter, but it's not a shock to us. You and I have known about this for some time. It's only a surprise to the mainstream media, who, of course, they don't pay attention to what's going on out there. The mainstream media made a huge story about this. Here's a clip.
A decline of 32.9% for second quarter GDP.
We just learned this morning U.S. economic growth shrank 32.9% in the second quarter. That is by far the largest quarterly drop since record-keeping began.
As you heard there, guys, most of the people in the mainstream media, for them it was a shock, because they're not paying attention to the same things we're paying attention to. For example, I mentioned this several months ago. You may remember my video from some months ago. I said very likely we're going to see a negative growth in the last quarter from a prediction made by Morgan Stanley. Here it is. As far as the economy is concerned, again, people ask me all the time, Alessio, what do you think about what's going on in the economy? How bad could it get? Take a look at this chart here, courtesy of Morgan Stanley. So they're predicting there will be a negative growth for the second quarter, which is not surprising. But they're expecting by the third and fourth quarter, we'll be back in green, back in a positive. Now, you might say that's being way too optimistic. Maybe so. We don't really know. Actually, it might depend a lot on how quickly people go back to work. So guys, as you heard there, if you've been watching our videos, we've known already that Q2, the second quarter, was going to have a negative growth. But here's the thing, guys. This particular chart of bonds, the fact that it's been going up, again, is telling us, giving us two warnings. Firstly, that the forces of deflation are still with us. Not inflation, but deflation is winning. As you can see from this chart, guys, deflation simply means we're going to have falling prices, falling demand. So falling demand leads to falling prices. And of course, that leads to companies going bankrupt, becoming insolvent. And of course, they have to lay off jobs. This deflationary cycle, this vicious cycle of deflation just continues and continues until, of course, leads to lower and lower prices. And that's what bonds right now are showing to us. In fact, they're predicting that we're going to have deflation winning for some time. Now, eventually, when the bond market implodes and goes down, then we'll know inflation is winning. But at the moment, guys, the fact that bonds are going up, that means deflation for the moment is winning. Now, there's another thing that this chart of bonds is telling us. The fact that bonds are going up also means that uncertainty still exists in this market. Again, no big surprise, but the fact that bonds are going up, it shows that investors are pricing in more uncertainty and more volatility in the medium term, in the next few months, and potentially by the end of the year. That's not surprising because, again, we've got the uncertainty with the economy, uncertainty with COVID, with coronavirus, and also uncertainties with the election. In fact, there's a lot of news reports that tell us that the uncertainty with the election, the US election, may not actually be with the election itself, but what may happen after the election, in the period and months just after the election period. Now, that's something we'll talk about in a separate video, but there are going to be some uncertainties, I think, between what's going to happen between the election day itself, November 3rd, and Inauguration Day, which comes in January. So there's a lot of uncertainties that could happen between that period, which we just don't know about at the moment, guys. Now, we'll talk about this in a separate video. That could be quite interesting as well. But the bottom line is this, guys. The fact that bonds are going up with the stock market is warning us. Again, deflation is winning and uncertainty, volatility is coming for us potentially in the next few weeks or months. The bottom line is we need to be prepared. We need to be ready. All right, guys, so I'm going to try and crack on with some music here on the keyboard. I'll see you guys soon.